What's up, guys? Today I'm analyzing Procter and Gamble. This is actually a super easy company to analyze because they're super consistent. All they do is sell consumer goods that people purchase like every day, like toothpaste. So it's going to be a very easy stock to analyze, and I'll show you why. This is a 5-year chart. They've returned 56% over the past 5 years with a 2.3% dividend. They have underperformed the S&P 500 and I will expect that going forward, and you'll see why. Okay, they are a $378 billion company. Their price to earnings ratio right now is 26. Seems kind of steep, especially for a company with like almost zero growth. So yeah, let me show you in their financials, checking their revenue and their revenue growth. They went from 65 billion to 82 billion, and it looks like they've been growing at about like 3% a year. You've got 3% here, just 1%, 4%, and then yeah, because of like the money being injected into the economy, they grew a little bit faster at like 5%, and then they slow down to about 2%. And yeah, about 2% or 3% in revenue growth. And in terms of their net margin is super consistent, at least except for this year. Except for that one year. What year was that? 2019. Except for 2019, they've hovered around like 18%, 17, 18%. Yeah, so that's what I'm going to use for the discounted cash flow model that we're going to run this thing through. But let's check their balance sheet. Their balance sheet is okay. They've got net debt of 27 billion, which is kind of high. Their net income is 14 billion, so it would take 2 years to pay off the debt. In terms of cash flow, they buy back a lot of stock. They also pay a lot of dividends, 2.3% yield or whatever. So decent dividend yield, not amazing or anything. Let's check their analyst estimates. For analyst estimates, they've got $6 per share coming in 2024 and then 6.44. And in terms of revenue, they're guiding for a revenue decline for next year, and then the year after that to increase by about 4%. So I ran that through a DCF model. And yeah, this is a super easy company, so I think this is going to be a shorter video today. But let's zoom in on this. I put their EPS estimate, their revenue estimate here, and the next year's growth. Actually, they were predicting 4% growth, so let's put that there. And yeah, earnings growth, I just put 3% because that's kind of where their revenue growth has been at. And assuming consistent margins, I'd say 3% growth there is fair. And then for the revenue model, I put 3% growth in for the revenue, which I think makes sense based on their historical growth, and then the profit margin at 18%. It has hovered between like 15 and 18%, so I even went with the higher end of their profit margin and staying consistent with that. And an exit multiple 20. I think 26 is very steep for this business, and having like almost no growth. Even an exit multiple of 20 is kind of high. So, I mean, it's possible I could use like 15 here, but 20, they're not going away anytime soon. So I think an exit multiple of 20 would mean like a 5% yield on like the earnings, which is around like the bond yield right now. So I think that is fair. And a discount rate of 10% because I want the 10% return on my stocks. And we can see that the fair share price is about $90 to $100 in both models. So I'd say like the fair share price would be around like $95 a share. And that's if you want the 10% return. But I'd say if you're buying them today, let's see if about 5%, you'd probably be expecting like, yeah, I'd say if you bought them today, you'd probably be expecting a 3% return moving forward. So yeah, not good. I'm definitely staying away from this stock. There's so many more stocks that are better than this. So yeah, definitely gonna stay away from this one. If you guys have any questions about this, make sure to leave them in the comments. And if you want to try this spreadsheet for yourself, just check the description. I put a link to it in the description. You can use it if you want. And yeah, hit that like button, and I'll see you in the next video.